Let us see the next question. Mrs. Sky Products Limited of Mumbai, an exporter of the seafoods, has submitted a 60 days bill for negotiation. The company has desired to keep 50% of the bill amount under exchange earners foreign currency account. Means in short, say 50% of the bill will not be withdrawn. The rates for the United, that is rupees per dollar and dollar per euro in interbank market rates are quoted below. The exchange rates are given: spot 1 month forward, 2 months forward, and 3 months forward. Transit period is 20 days. Interest post shipment credit. Post shipment credit is 8% per annum. Exchange margin is 0.1%. Assume 365 days in a year. Calculate first exchange rate quoted by the company, so quoted to the company, cash inflow to the company, interest amount to be paid by the bank, to be paid to bank by the company. That is the question. Please go through the question. Friends, please take this small correction in the question. 60 days bill for the negotiation for, that is, has submitted 60 days bill for euro 5 lakhs drawn under an irrevocable letter of credit for negotiation. So please add this much. So let us have understanding. The question is providing the information that there is an Indian company which has exported goods and it is going to receive 50,000 euro. It wants to keep the 50% of the amount, say, in the foreign currency account only. So only for the 50,000, so there will be a kind of like repatriation or exchange will be made. Rates have been provided to us for rupees per dollar and for dollar per euro. So basically we know that say the cross currency rate is required to be found. So it is sell of euro and purchase of dollar, and sell of dollar and purchase of rupees. That is the way the two rates are required to be found by us. Conversion of the dollar, that is a euro into dollar, so you'll get less amount of the dollar, and conversion of the dollar into rupees, in that say again you will get less amount of the rupees. These are spot rates. Of course we are not concerned with the spot rates, we are concerned with the forward exchange rate. So this 2 months rates which have been provided to us, that is the forward points or the swap points, that we will take into account. Okay. The question is providing further the transit period is 20 days, means it will take, that is a time period of 20 days since completion of the entire procedure. Interest on post shipment credit is 8%. So immediately we are going to discount this, so the receivable, and say whenever the bank is going to receive, so at that point of time, so the bank is going to stop charging interest to us. Till that point of time the bank will charge so the interest at the rate of 8%. Exchange margin 0.1%, and of course we understand so it is required to be calculated only for the interbank market rates. Since the rupee is the home currency, this is the interbank market rate for which so the margin will be considered. Not over here, so the margin will not be considered, because there the bank itself is also say doing the transaction with the interbank. Assuming 365 days, that's fine. The first question is, what is the exchange rate quoted? For example, like we do this, so the multiplication, division, everything, and with that say we get the exchange rate of, let us say, 70 rupees per euro. So what will happen? 25,000 into 70. Sorry, the answer of the first question will be 70. Second is the cash inflow to the company. So whatever this forward exchange rate that we have calculated, listen me carefully, whatever this forward exchange rate that we have calculated into 25,000 is the amount which will be given by bank to the company. And on this amount, the bank will charge interest for a time period of 80 days. This is what we understand. Please write down answer for the question. First point, in this question, information is given that Indian company has exported goods, full stop. It is going to receive euro 50,000. Second point, only 25,000 euro will be converted in rupee currency, full stop, using cross currency rate, full stop. Third, as per the information given, bank will make payment to company right now, and afterwards it will receive the amount from customer in bracket I am writing customer of Sky Products Limited, full stop. Third point, we have to pay interest for 80 days, that is 60 days of credit plus transit period of 20 days, full stop. Answer of the first question, exchange rate quoted to company in that rupees per dollar rate is given, and dollar per euro rate is given. Okay, two rates are given to us. Spot rate is 67.80 slash 67.81, and over there it is 1.0775 slash 1.80. As far as the 2 months is concerned, for 2 months it is 21 paise slash 22 paise, and over there it is 0.40 cent. So here 0.0040 and 0.45 cent. So 0.0045. Remember that say 40 cents and 45 cents are not given. 0.40 cent is given. And over here it is directly 21 paise and 22 paise have been given. 67.8 plus 0.2. 69.01. Sorry, 68.01 slash 68.03. On the other hand, it is 1.0775 plus 0.004. Be careful. 1.0815 slash 1.8045. This is rupees per dollar and this is dollar per euro. The transaction is sell of euro and purchase of dollar. So you'll get less amount of the dollar. So it is 1.0815 dollar per euro. And the other is sell dollar, purchase rupees. In that say again for every $1 you will get less amount of rupees. 68.01. That is how we will have the two rates. Final answer is rupees per euro. So 1 euro is equal to how much rupees is the question. Rupee is final answer. Answer is required per euro. Against euro, which currency is given dollar? And against dollar, which currency is given rupees? I want rupees per dollar, that is 68.01. And you can see it is sell of dollar and purchase of rupees. So you will get less amount of the rupees. In a way that you are supposed to pay margin. So minus 0.1 percentage. Okay. Because we understand let's say the purchase rupees means you are going to receive. So you will receive less. Into dollar per euro and the same is given. So we don't have to change it. So the answer is 68.01 minus 0.10% into 1.0815 into 1, that does not make a sense. 73.80. 4792 rupees per euro. That is the exchange rate applicable. Answer for the second question. Cash inflow to the company. So in that 73.4792 into, so the amount is an amount of 25,000. That is 50,000 into 1 by 2. 73.4792 into 25,000. That comes to 18 lakh 36,980. And third is very simple. Interest payment by company to bank. It is PRN upon 100. So 18 lakh 36,980 into rate of interest is provided to us as 8 percentage into time period is 80 days. And question is specifically providing that say you have to take 365 days, so there is no ambiguity. So 32,210. 0.06, that does not make a difference. So summary of the answer. First of all, the exchange rate is calculated using the buying and selling rate and the transaction in which we are going to enter upon. Just this is what's one of the point which is important. So be careful because they have provided in the cent term. Calculation of the exchange rate, and over here say only for once the margin is required to be considered because that is our domestic currency. Cash inflow to the company is very simple because this is the amount of the loan which the company is getting, and interest for a time period of 80 days, that is 60 days plus 20 days, that is required to be found.